easy ways out in terms of just trying to build something out. They're not all going to be like multi-baggers, right? I mean, fine, I'd love to think that, but I'm fooling myself, I'm fooling others. It doesn't happen. I could have made a lot more money, but I could have lost a lot of money as well. The biggest lesson I think is the lesson of rejection. To be able to accept rejection, to be able to be thick-skinned.
Welcome to another episode of Inside the Family Office, where we go deep to understand what it takes to run a successful family office setup. My guest today is Rishabh Mariwala, managing partner at Sharp Ventures, board member at Marico. He started young. His entrepreneurial journey, he started with Pure Sense and soap opera, and today he is guiding the family office into becoming one of the most respected consumer investors of the country. He's not just carrying forward legacy, he is building or rewriting it, I must say, one startup at a time. Hi, Rishab. I welcome you to this episode of Inside the Family Office. Rishab, in the book Harsh Realities, your father, Mr. Harsh Mariwala, he spoke about breaking away from family business, Bombay Oil Industries, to found Marico. And you somewhere have a very similar journey of while being in Marico, starting your own ventures and then breaking away into entrepreneurial investment journey. So, what is this commonality that binds both of you? And you want to talk about that and also how your father reacted when you mentioned to him that you want to start Sharp.
Yeah, so that's a great. I mean, I didn't even think that there was a commonality there, but now that you're saying it, it's sort of, there is some similarity,
Yes.
Yet some difference. I think for me, it was two breaks. One was with when I was part of Kaya, which was part of Marico, and then I stepped out of that
Right.
to start my own entrepreneurial venture. That was a much bigger break, frankly, than than starting Sharp Ventures. So I think that for me, I always knew that I wanted to do something with business, but I didn't know what. And I think the move away from, I always thought I'd be working with him, which I did, frankly. I did end up doing that, but not in Kaya, because Kaya I was too sort of junior enough and I was just learning the ropes and things like that. So there was zero, he didn't even know what I was doing back then. He had a broad idea, he had a broad understanding, but he was just busy building Marico, building Kaya. So
Right.
there was not there was zero oversight actually, and I of course always have and do respect him. So always wanted to work with him, and that didn't happen in Kaya. So I think when I broke away and started soap opera and my own brand, that's when I started engaging with him. So that was one break, but I think the reasons were different. So the reasons,
That his was more massy, yours was niche, classy.
yeah, his was more, I think, from a family conglomerate to CPG. Mine was from a professionally listed company to an entrepreneurial organization. So very different. Um, and I was doing a 0 to 1 journey.
Yeah.
He had built his brands in Bombay Oil, right? He was building a parachute and a Saffola within the Bombay Oil construct, and then started Marico so he could focus on just CPG, right? And it being a different business vertical altogether, where he could attract talent under the Marico banner, um, and that gave it an identity of its own, right? Um, and I think that's what, frankly, we all seek to do, right? To have our own identity.
Yeah.
And I think that my first leap was entrepreneurial, and that was saying that, look, I want to. I mean, in some way or form, it was saying that you want to have your own identity, and I want to break free from what I initially believed was my identity, but later realized that I have to build my own identity, and there's a saying that
Nothing grows under a banyan
exactly
tree.
exactly. So that's exactly what it is. So nothing grows under a banyan tree, because there's so much shade that the sunlight is not there. So I had to go out and create something outside of that, and this gave me the, I think it sort of broke away a lot of the layers that were there, and allowed me to take risk, to be my own person, to build faith in myself, and to build faith in what I'm doing, and have the confidence to go and do my own thing rather than living in his shadow.
Great. And continuing to that question, in fact, in his book, he's spoken a lot about the obstacles he's faced. What is your own harsh reality, Rishabh?
Yeah, so I think it was this sort of, you know, learning and unlearning. I think the whole entrepreneurial journey for me was the 10 years that I spent just you know doing doing things by myself and getting things done, and just creating a whole 0 to 1 journey as a bootstrap business, and finding my own
All
identity.
little details, everything, you pay attention to every little
Everything.
thing.
Yeah.
Yeah.
I mean that's the job of an entrepreneur, and ground up realities in this country. I think how it's not easy to be an entrepreneur here, and I mean everyone faces it, not just me, but just being able to appreciate and coming from like privilege, and then saying that okay, you start at ground level. It sort of reset the clock for me, and it sort of I didn't have any air cover one way or the other, and just being able to grow very very organically, and it was all a function of how much input I put in, um, that could come out in terms of sales or in terms of output, in terms of what I was trying to build, and that itself took a while to do, because you literally, like, for me it was soaps. It couldn't get more simpler than that. But you know everything from, you are the boss and you are in charge of your marketing, your positioning, your pricing, your product, your packaging, um, to your customers, to your vendors, to everything, right? So to your manufacturing. So I think just ground up getting that reality check was real for me, because I didn't know what it was like to do business in India as an entrepreneur, and that really taught me, like, you know rejection, getting rejected.
So if I ask you, what is that one lesson you learned with your soap opera and pure sense venture, which a boardroom setting it at Marico wouldn't have taught you? What is that? Is that rejection or is that something else?
No, I think it's just like just being able to have that grit. So for me, the biggest lesson, I think, is the lesson of rejection. So having multiple no's, and then turning those no's into a yes, and how that respect is earned, not demanded, or not something that not commanded or demanded, right? But how respect is earned. That's been a journey for me, because mm, you know I think when you go day in and day out, and you're on the field, or you're interviewing people, or you're getting folks on board, or you're in the marketplace, and then seeing your product versus other brands, seeing how they're doing versus you're doing, that reality is real, and how you seeing some brands succeed and then you don't. It's just like humbling every day. And I think just that itself, that constant sort of being at it, for any entrepreneur, I think is a challenge, right? It's not easy, and I think it's taught me to be able to accept rejection, to be able to be thick-skinned. Very important in this. I think you just I don't think just being able to face
Perseverance and then just BRL.
yeah, perseverance, having that grit, and that thick skinness, in terms of just being able to power through some of the failures that you have, or some of the issues that you face in in business, in investing, or in operational businesses. It just helped me a lot.
Rishabh, moving from running your consumer brand to
Yeah.
managing family wealth, so there is a change of mindset from operating mindset to a capital allocator mindset.
Yeah.
So when you have an underlying business which has a healthy ROE,
Yeah.
throws cash, when you do this kind of a transition, what is it in the journey that you probably have to unlearn? Or how do you kind of navigate this transition? And it's a very important question also because there are a lot of families and a lot of new generation, families out there who are grappling with this idea that, when do we make that switch? Should we make that switch?
Yeah.
So I think
I mean,
it's
that's
a
a
very
very
critical
relevant question
one.
for families and for family offices, because, for me, I'm an individual. I'm lucky because I'm in a space where it's completely professionally managed, right? So
Yes.
I can afford to spend a lot of time on my family office. There's some families who can't
Yeah.
because they're running the show in their operational businesses, and time is the most undervalued commodity which people forget. So spending significant amount of time on I actually I love investing. I enjoy investing.
Yeah.
I love venture capital. So for me, it is actually very easy. It was actually zero mathematical. There was no mathematical thought process out here because the business was running, and in fact, it was for me. It was much easier to move from a like the tough part for me was leaving Kaya and Marico and saying I want to start my own thing. I think that was an identity thing for me to have my own identity, um, and I want to just enjoy what I do. So for me, it was very much about identity and just saying that look, I want to enjoy what I do, and tomorrow it's not about fine. Do I
But
want to make
like
an
you
impact?
mentioned, you had luck. You were lucky.
Yeah,
Not everybody has that luxury.
not even has the luxury. So, but then that then begs the question that okay, fine. Are you managing your own capital or do you want other people to manage your capital, right?
Yeah.
Then are you in the capacity? Do you enjoy it? Are you giving it time? And how much expertise do you have in it? And how willing are you to learn? Because it's a learning journey as well. When families are starting out, they don't. I mean, you're starting up pretty much at ground up. They might have studied finance and they might be reading the papers and having friends who invest,
And
but
that's not enough.
it's not enough. It's not enough.
Yeah. In fact, when you started small. You started with professional managers,
Yes.
big time. So how do you evaluate professional managers?
Yeah.
And when you started, how did you do that?
Yeah. So I think it's critical to meet everyone and to understand. I think their pedigree, their reason to start a fund and why they're doing what they're doing, and then their right to win. How they find deals, how they do diligence, what is their exit pathway, what is the operating partners that they have in their firm, how they're adding value to entrepreneurs, and what and how they see the industry turning, and why should I invest in them? So what do they have that others don't? And I mean, it's very similar to even investing in an entrepreneur, but as a fund, what is their track record? So they first time fund managers or have the partners. Ideally it's a partnership and it's a bunch of partners, but what is their track record working together? I think if they've worked together successfully, that avoids potential conflict later on. So all these aspects are critical, and just appreciating their background and their journeys, and because that's what you're underwriting at the end of the day, and then the category, whatever category they're investing. Is it fintech? Is it AI? Is it deep tech? Is it climate change? Is it consumer? What is it? What are they investing in?
So, in a sense, if you really don't have that time and bandwidth, it's better to rely on managers and then choose accordingly and understand that what is their expertise and how true they are to their philosophy.
Definitely. Yeah. I think that even if you, as I said, like you can dip your toes in, so don't bet the house. Don't go
Yeah.
big, right? You start
Start small.
small and you will make mistakes, and that's natural, as did we. We also made a bunch of mistakes in terms of choosing managers. But over time we realized that okay, fine, what do we get? What do we understand? What style do we like? Because there will be a style that one will naturally gravitate towards, and then it's just easier to take those decisions, because then okay, fine, I like or don't like this fund manager for z reasons, and that's why I want to go ahead with people like them or back them further. And
And eventually, as you develop expertise or you have a team working with you, that's when you can look at doing deals on your own.
Deals on your own. Exactly. Definitely. You have to have a reason to do a deal by yourself.
See, because a lot of younger families we've also seen they chase venture style returns, and there's a lot of gut based investing which happens. While you have always spoken about institutionalizing the entire process,
Yeah.
that get your process right. So, input is in our control. In fact, that's something we follow at, our asset management company as well. That input is in our control and then outcome will follow.
Yes.
So, you want to talk a little bit more about that? How can one really institutionalize this process of investing?
Yeah. So
Avoid gut-based investing, basically.
no, definitely. Again, to me, it's quite formulaic, but it's easy for me to do it because I do this full time now.
Yeah.
But I think if I were to just like break it down and simplify it into pillars in terms of how does one not do gut based. I think it's about just having. I think if the family has a passion for something, then start with just time spent. It's not about capital invested, it's about time spent. So what is your return on time invested versus your ROE?
Yeah, this is a good
Right.
one. ROT.
Yeah, ROT, return on time
ROT.
invested. Yeah. So I think that's critical because, say you see, I mean, it's simple, right? There are multiple organizations that have these where you can go and you can be part of these pitches. You talk to other fellow investors. You understand what drives them, what they like, what you liked about the pitch, what you liked about the founder. Go talk to the founder. Go understand it. Go understand the why they're doing what they're doing, and just if it's, I don't know, rockets that you want, then go and meet everyone in the space in the space industry, and then understand all the moving parts around that, right?
But how do you filter? Are there any thumb rules? Because there are pitches by Diamond Dozen today available for everyone who
Right.
has capital. So, are there any thumb rules that one can apply?
Yeah, I mean, look, it depends on the stage. Um, like for us, it's early stage. So for us, again, I've shared this earlier, but it's you're betting on the entrepreneur, more on the entrepreneur and less on the category. So I'm betting on the jockey, not the horse. The
Okay.
jockey is the entrepreneur, the horse is the category or the industry. So I would bet on the entrepreneur, and again, it's about your ability to understand that industry. So, if these families have, say, if they're into, electrical appliances, then they understand the industry.
Yeah.
Because they understand the industry and they understand the moving parts of the industry, what part of the value chain can they play in? Is it the end part? Is it the B2B part? Is it the supply chain? Is it the distribution? And because you'll have entrepreneurs in all aspects of that supply chain or all aspects of that life cycle of that industry. So what part do you does that family office want to bet on, and what part do they understand, and then it's backing that. So it's from a circle of competence that they're coming from, and I think sticking to that circle of competence is critical, because then you will understand, you'll have domain knowledge expertise, and because you have domain knowledge expertise, you'll know what's right, what's wrong, and what's broken, what's not.
Yeah, in fact, I think more of your investing has always been consumer investing.
Yeah.
I think that's your domain expertise. So, Rishabh, consumer investing is notoriously trend driven.
Yeah.
So, how, when you're making investment decisions, how do you guard yourself against your own personal biases? In
Yeah.
in terms of taking investment decisions, because
Yeah.
there are hot trends, there are fads, they don't sustain after
Yeah.
16 months or 24 months.
For sure. No, I think that look, I, especially investors in big cities, we are more the India, we're not the Bharat, and sometimes it's not consumers like us that if we as consumers ourselves think something's great, but we are like 1% of the country. So how we as investors investing in Bharat and not in the tier 1% of the country, even though their wallets might be bigger and their AOVs might be bigger, but how does an investor invest for Bharat? I think that's where, to me, it's a function of just understanding what's happening in those geographies and with those consumers. So have your ear to the ground with some of the uh, trends that are happening. I'll give you an example.
Yeah.
There's a company of ours called Kioskin, which is AI for and it's dermatology based. So basically, you take a photograph and you have pigmentation or you have whatever acne or whatever it is, right? Then it's surprising, but the kind of people who actually do this, download the app and actually use this, it's mind blowing where
Yeah.
people from the smallest of cities and towns are doing it and they're okay spending 500-600 rupees. They just don't know better. They're like, okay, doctors, and they actually do have doctors on the back end who are advising them. It's all through the app. So you have the entire the photograph is gone on the app. The doctor can communicate through voice notes on the app. So it's a very closed system in through because it's app based. But that consumer sitting in Gorakhpur or
Some tier 2 city or town.
yeah, it's mind blowing the way in which it's not just people like you and me who worry about our skin, but it's even the tier three, tier fours who are and who don't have where annual monthly income is just 2, 3, 4 lakhs. So it's surprising. But it's a function of ear to the ground. That's one. I would also say it's a function of the team. So diversity of the team is critical. So how do you not have blinders on, right? I mean, that's your question, saying that how do you make sure you're not indexing on something um uh, at, uh, when your biases are setting in, and
Absolutely.
that's when you have a diversity of team. So I've always tried to have you know people from different cities who are not just Bombay based. I've tried to have just a good equal in terms of gender, because the way women look at products very different from the way men see things. I've had to try different age groups also. We've got 22-year-olds. I've had a 60-year-old working with me. So I think age, gender, coming from different cities. I've had people from investing team members from Baroda and small cities in Gujarat coming in and being part of our team. So all that sort of
Diverse intelligence.
makes a big difference. I think just in terms of being able to see things from a multi-focal lens rather than very unipolar.
Yeah, that's how you avoid biases. No, that's a good one, Rishabh. Do you want to kind of mention a hot deal that you walked away from?
Couple, I mean,
Which
there are
helped you?
lots,
Yeah.
lots. So, two really hot deals, and I think we had these founders come, and we have a foundation here, and through the foundation they wanted to understand how do they go digital. So we connected them to our digital head, and they were making low cost. No, they were making low energy use fans.
Okay.
So he said, "What's the big deal in this? You're gonna save a little bit of money here and there. It's not gonna make a big difference." And then they had this BLDC motor, and then the business today is almost, I think, touching 1,000 crores. It's called Attenberg.
Of course. I was just going to say that.
Yeah, so that was one, and they were right here, and they were in our office, and they were like, "Can you give us some money? And we're looking for capital." And both my colleague Chaitanya and me thought that this is not something that's going to be game changing. It was.
It worked.
It worked, and the founders are phenomenal, and they're good friends of mine, Arindam and the two others. But stuff like this, we've missed. Or even similar to that, there's another one where just really cool luggage, and before luggage had taken off, and super premium.
Okay.
And we had like
I know
3
what
days
you're
to
talking
invest.
about.
Yeah, you can say the name, Mokobara.
Mokobara.
Yeah, so um, uh, and I know the investor source was there, and he said, "Come on, you have 2 3 days time." Another friend of mine is an investor, and we met the founders, and then he said, "You only have 3 days time." I said, "Look, my diligence, I need time to diligence the business. If you don't give me time, I have to pass." So I passed it, and
Rest is history.
Rest is history. Yeah, yeah. But I think we all, for all, I think that's a cross to bear for all good investors will have their own set of anti-portfolio companies,
Yes.
which are where founders have come to you and you rejected them, and you know. I think the good thing is that at least people are reaching out to you, and the quality investors are reaching out, quality entrepreneurs reaching out to you. So
Yes.
that's the positive. The negatives, of course, you missed that deal, but you know that's part of the journey.
And in our parlance, we say that you can't be at every party.
Exactly.
So, you
Exactly.
can't buy
I
every
love
winning
that.
stock.
I love that. You can't beat every party. Yeah, wow, that's fantastic.
So, in fact, okay, Sharp, the structure, the way it's structured, it allows you more than any traditional VC, it allows you that flexibility, the luxury, the privilege of truly patient capital.
Yes.
Yeah. So, how do you ensure that this patience does not turn into complacency? So, how do you know when to sell, if
Yeah,
at
so
all?
great question. I think, you know, we've had our share of lessons as there as well. I think one was, you know, we had one of our companies went public and that we invested in at a very early stage. And then, you know, they IPO'd at, you know, $1.5 billion. You know, we, our sort of, you know, we had a lock in that there was no lock in at that time. Sorry. So we could sell. So we said, let's hold on. The P ratios were out of whack, but again, for consumer overall the sector also, it is very high. But this was this is this is unimaginably high. So you know, we had other investors were getting out, and you know, we didn't know that they were getting out, and they exited, and then for whatever reason the stock dropped. So, you know, we could have sold. So I think selling at the right time is critical and not being too greedy with holding on. So our logic was that hold on to your winners. That is our logic because, you know, the founders are great. The stock will continue compounding. But what I think we missed was the significantly high PE ratio. And when is it absurd and when is it unimaginably very high versus a good time to sell. So I think getting that balance in is critical. And if we had that, and it's all in hindsight, but the wisdom to be able to say, okay, fine, let it go, even though it's extremely high, and you believe in the founder, you believe in the business, but for whatever reason the market views it much way higher than what it actually is, it will correct. And being able to appreciate that correction upfront is something that I did not do and we did not do as a team. So those are lessons where I think, you know, the right governance in terms of when to trim and when to cut. You know, I think, you know, book some profit. So we, not that we were in the money out there, but we could have made more money, I think. And those are good examples of actually, you know, losing significant amount of capital just because you timed it wrong. And if you could timed it right, you know, in hindsight, you would be way better off. And it's just a function of being able to analyze that decision, the exit decision better. So that exit decision making should be critical, and we should always keep assessing that at every given stage that you have. So not just post IPO, but even during the journey of the company, when's a good time to take your principal amount out, or you know, if you believe that the valuation is extremely high, and you have to believe that the prospects of growth may not be as high as the valuation that it is today, then you know, take some amount out. You know, I think those are like critical lessons that we are also learning right now as well, and just timing that and getting that timing right and not being too greedy, not being too cautious. So having the right balance, the right mix, and these are hard lessons that you know, we're learning. And I think these lessons teach us everything. And I think if we don't learn these lessons the hard way, then it doesn't get institutionalized. It doesn't get sort of the rigor decreases. So just tracking when you can exit is critical.
Yeah. So, in fact, you touched upon governance. And I wanted to ask you that in your journey from being a founder to now managing the family office, how has your view on governance evolved? Like, in the sense that does managing a family office, do you think, does it require far more discipline? Because here, your mistakes, if they happen, they can compound over decades
Oh, for
if
sure.
you don't sell. So how do you look at that?
No, I mean, in fact, it's surprising. Like Aditi herself gave me a good sort of perspective. in terms of, we were talking about fund managers, and
Yeah.
he said, you have a 220 with a fund manager, and that 2%, if your AUM is large, that 2% really compounds.
Yes.
So, and that the eighth wonder of the world is compounding, as we know.
Absolutely.
So, just thinking about it through that lens, right? So that 220 in the larger scheme of things is not much, but if you look at it from a compounding angle, that can really drive big quantums of capital over a longer period of time. So we have to be really convinced about some of these investments. So I think it's small things like that, along with just simple stuff like asset allocation and just being disciplined about your allocation, your risk, your return, and your timelines. I think being disciplined in that and having rigor to that, and standing by that through and through, and making sure that you're, we call ourselves a river, not a pool. We're a river because we get dividend on a yearly basis, versus a pool where there's a liquidity event. We don't have there's no liquidity event for us, but because we get dividend, we're a river. So because we're a river, then we have to ensure that future asset allocation to what you're building. For example, today my sister is running our health initiative, and she requires a lot of capital for that. So I have to ensure that I give her that capital every year. I have to ensure that my team gets enough capital every year to do venture investing. I have to make sure that if tomorrow, if as promoters of Kaya, if we need to infuse capital into Kaya, there's capital for that. Or we're running an operational business, also a small operational business that we have, that my wife runs. We have capital for that. So I think that discipline of saying that, okay, I will be structured. This capital is put in treasury for right now. I'm earning lesser quantum of capital out there. That's okay. It's okay to take low risk here because I need that capital for tomorrow. And being disciplined from a capital allocation approach, being disciplined from just the governance mechanisms of I think simple things like diligence and legal DD, commercial DD, in terms of your the clauses that we have, your shareholder agreement, and those are all critical and very much part of the whole governance framework. I mean, and the operating reviews that we do in terms of compliance and statutory and taxation is also critical. And if the machinery and the back end is not strong enough, these things can lead to much bigger problems later on.
In fact, that is something which is not really well understood by a lot of families, and especially, newer families or smaller family offices, in terms of the back end research or the compliance or due diligence, everything that comes if you're running your own setup. So, keeping that in mind, somewhere it's also a trade off whether I just want to hire professional managers, or manage it on my own. So, is there some threshold that you have in mind, Rishabh, that, at this particular capital or at this threshold, probably you can, kind of do that switch of investing directly versus just staying with professional managers? Do you have some threshold in mind?
Definitely. I think that, look, it's a function of time, as I said. So,
Yes.
because we spend inordinate amount of time on venture capital, I'm always more focused on doing it directly versus doing it through a fund. But on the opposite side, on the public market side, with that say what a DSP would do, I actually don't have a strong view out there. So, I'm actually happy to say, here's my money, you manage my money, and it's less a headache, right? And I'm given to someone who knows what they're doing, rather than saying I want everything and do everything in house. That in house team, beyond a point, markets keep changing, and if you don't have a top quartile team, and even if you're paying you pay peanuts, you get monkeys, so you have to have quality talent, you have to have best in class people who know what they're doing, and that's where, like, in-source versus outsource, like, that'll help in the decision making.
Great, Rishabh. That was good to know. Rishabh, I know this will be a guesstimate, but and in your observation and experience, can you come at some success failure ratio that you've seen in private investing?
Yeah. So, I mean, there are two parts to it. Okay, one is theoretically what it should be in venture capital. And again, I'll just, from a stage perspective, it's more VC than PE. And VC, they say that it's around 2 in every 10 investments will return all your money and give you outsized returns, right? And that'll make up for all your losses, right? And give you much more. So
But 2 on 10 still sounds great. I thought it was a poorer number.
it's between 1 to 2.
Okay.
Yeah, it's between 1 to 2. It depends. India is still very different from the US, and venture capital is catching up to the US and to other markets globally. But I think 1 to 2 out of 10, unless you were thinking maybe 1 out of 20,
Yeah.
but maybe I would say 1 out of 10, 2 out of 20. I mean, maybe you could be right. Um, but I would say that's the theoretical answer. I think if you really know what you're doing, it could be 2 out of 10, which will give you outsized returns, and the remaining like 3, 4 will give you your capital back. So you get your principal back, and the others will just be
Fizzle out.
Fizzle out, yeah. And you have to have a very high hit rate. So, a lot of the VC funds just go out and invest significantly, and now the pools of capital in venture are just increasing dramatically, and you're seeing just a lot of deployment of capital, and the velocity, the deal flow velocity is just real right now in the market today. I think if I look at my own portfolio, again, it's a function of vintage, and that's the difference that family offices have over venture capital, where we can deploy it. There's no 4 years of deployment. Usually, venture funds and PE funds have saying that we're going to deploy it over 4 years. Then invest, then it takes 4 years to harvest, and then 2 years to divest, and that gives them the 10 to 12 year horizon, which then you get your money back as an investor in a fund. In venture, there's no invest, harvest, divest approach because you're investing every year. So for us, I think we've been have different vintages from 2015 to 2025, and we've done around 33 deals. So it's been a mixed bag because you would have to look at it in that year of investing. So in 2017, when you invested, 8 years from, I mean, that's happening now. So now I can see the my IRRs and where they're placed, because there's one, what's exited, right? What capital you've got out and it's liquid. Two is what's on paper, right? So there's DPI, and there is the multiple on invested capital, the MOIC. So the DPI is what we want to track, and what we have not on paper, but uh, actually what's liquid, and that's a difficult calculation to do, because I think every year will be different, and you have to wait for those long journeys to happen, for the 8 to 10 year journey to happen to really understand. But if I look at from an IRR, we are sort of done phenomenally well. But I think that's how one should view this aspect that you're talking about.
And also, what would you advise, and especially for newer families, for upcoming family offices, do you have some number? What should be a proportion between public market investments, private? Because we know that public market investments are largely liquid, and though you don't need that liquidity, but and I'm sure this also depends a lot on the family office, the structure, and other
Yeah.
things. But is there a number that comes to your mind that what should be that ratio like?
No, that would be a complete misnomer, and that'd be unfair to say, frankly, because every family office is different.
Yes.
So their needs are different, their liquidity is different, their risk appetite and the return is different, and how they are wired is different. So for us, because we had Marico, and because my father believed in the public markets, we're very aggressive, right? So our risk is high risk, right? We were 90-10 when we started. So 90% in public, 10% in unlisted. That 90-10 today is at around, it's around 60% um, listed, around 30% unlisted, and 10% in treasury.
Okay.
So my and that treasury is also so that it could feed into the to some of these other businesses that I was talking about, and that's why you need the treasury. But otherwise, I wouldn't even had the treasury if I didn't have to have it. I would be 40% unlisted. So that's aggressive, but that's us. That doesn't mean that it's for
Correct.
everybody. I think everyone is different, and It's how they're wired. I
How they're wired, what they understand, how good they
yeah,
are at it.
yeah, definitely.
Rishabh, a mega trend, a investing mega trend, I must say, that you see playing out over the next decade.
So
Not much spoken about, or
so you have the Ozempic, right?
yeah,
Novo
of
Nordisk is
course.
the
Everybody
most
talks about it.
it's the most valuable company in Europe, Novo Nordisk, and the generic. It's going to become a generic by March 2026. So I think something like weight is going to be a big issue. It is a big issue, and having a low cost generic to an Ozempic is going to change the game in this country. So I think every other pharma company is going to go after this, and that will create an entire ecosystem because the minute that you lose weight instantly, your food habits will change, um, you'll have sagging skin. People will have sagging skin. You will
So you
need
need to address
you will
that.
address that.
Second order effect of Ozempic.
Exactly, exactly. So there'll be an entire ecosystem that's built around in Ozempic, somewhere in that zone. Um, and so you'll see that. And when it's generic, means that it'll be the middle class consuming it. So that'll be just a huge shift. So I think that and just Q-commerce is just changing the way we consume. So you'll have lower shelf life, healthier products coming in. You'll have 6 month shelf life, and that's okay. You don't need a 2 year shelf life. So all the preservatives that we were consuming earlier, you don't need that.
You don't need it.
Um,
So
so
you're talking, this is very specific to India.
to India, to
Yeah.
India. Globally, frankly, I don't know. AI is just changing the game globally, and I think the effects that AI will bring in into every aspect of the human being will just is changing as we speak. Um, but I mean, there are better experts than me to comment on that.
Sure. Rishabh, family offices are evolving very fast. What is your advice to the next gen and newer family offices? Because there's one celebrated patriarch in our country who's kind of also mentioned that how most of the next gen wants to manage wealth and wants to invest and not pay attention to operating businesses. How do you view this? What are your thoughts on the same?
Yeah, I think that entrepreneurs are respected more in the country than investors. That's for sure. And I buy his point that you're building businesses versus investing, and there's more to building rather than investing, which is bad. India needs new businesses to get built by, and if it's not the next gen who builds, then who will do it? But I have two counters to that. Um, One is that every family is different, right? So in my case, uh, our DNA was my father was clear. I mean, I am still investing. I'm still investing. So that is still an entrepreneurial from an investing perspective because I'm what I'm doing is I'm giving all the capital. India needs domestic capital.
Yes.
Who's going to provide the domestic capital if not for us, right?
True.
Why should capital be foreign capital? If there are, if we are putting our capital at risk, right? And we are investing in risky businesses and entrepreneurs who are then fueling the economy, and that money is being circulated back. I'm not doing it for my lifestyle. I'm not doing it for other things, right? I'm not doing it. I'm not gambling with it. If I'm not gambling with it, there's risk, but risk is not gambling. So I'm taking a calculated risk, is how I see it. So that's not gambling.
Vicariously participating in operating businesses.
Exactly. So I think that I'm adding value to the domestic capital of the country and having that capital circulate back into India. If I'm successful in investing, that capital is only going to go back into the country, right? So and India needs more domestic capital. So rather than a lot of the big exits that have happened, where's most of the money gone? It's gone out of India. So we need more domestic capital because most of the private equity funds, where have they, who's given them the capital? It's foreign capital, not India capital, right? So here we're actually investing within India, and because we believe in the India story before the India story became the India story, right? So there is a rationale and there's a sort of strong counter to that in terms of I think domestic capital is one, and two is that every family is built differently. So um, when I started, it wasn't easy for me either. But when I was working in my father's organization, but I think he had this thing of firm first, family second, right? He had this mindset, and you know he was busy building up the business and the org, and you know I found there was no space for me as a family member in the organization. So because of that, I became an entrepreneur. I tried being an entrepreneur. It's not like I didn't try. I tried doing it. I did it the right way. I did it bootstrapped. I did it the right way. I realized that I enjoy investing more than operating. Um, Now, I can't blame myself for that. I enjoy doing what I do. I'm taking that calculated risk. So my
And you're
logic,
good at it.
and I think I'm good at it. Yes. I mean, we'll find out later on, but so far so good. So I don't think it's as binary as they say that it's. They should just be focused on building versus investing.
Yeah, and in fact, I would like to give it a little of an economic twist myself. And that actually that quote reminded me when I heard that, when I read that in the newspapers. It reminded me of Atlas Shrugged and Ayn Rand, that book. If you've read that book, uh, which talks about, see, capital is free flowing, and in a democratic society, when capital is free flowing, it'll always go where whoever can make good use of that capital and scale business and generate profit out of it.
Right.
So I think eventually we'll just have more of first gen entrepreneurs, which is very good for the country.
Totally, totally.
Yeah.
I think
It's not the prerogative of next gen to always run operating businesses. We can always have more of first gen entrepreneurs in the country.
Completely.
That's good for India.
100%. And you back them, and you are fueling the economy in one way or form.
So, Rishabh, let's move on to our next section, rapid fire with Rishabh Mariwala. What's the most overrated consumer trend that you're very happy to ignore? No judgments.
Sure, I think there are quite a few consumer trends which are overdone, and sometimes it's the function of the quantum of capital that's there in the market, and sometimes it's a function of just entrepreneurs that are trying to do new things and easy ways out in terms of just trying to build something out. I would say that even though I've been a beauty personal care entrepreneur myself and have multiple investments in beauty personal care, every second founder I meet today is doing beauty personal care.
And made good money also.
So I think we see the successes, but I think there's a graveyard of failures that we don't see. And because now the limited moats to actually starting a new brand, so you get a lot of founders doing that, but you will get a lot of entrepreneurs and funds that will be investing in BPC, and where it's actually a lot more tougher than I think founders think it to be.
Okay. What's your personal investment pet peeve? The kind of startup pitch which kind of quickly raises your eyebrows and like it's more like a red flag to you.
I think when there's too much of um, focus on pedigree, when they keep reinforcing, where they've studied, without it, and make putting it on their, displaying it too proudly. I think to me sometimes that can put you off very very easily, and that when that humility is not there, I think where founders, make big claims and have these crazy big ideas without there being any ground to it. I think some of that just bravado, or talking too much about pedigree. Those are things that can really put investors like us off.
I agree with you. In fact, personally, I feel if you've been in business or a certain profession for more than, say, a decade or two,
Yeah.
and then if you still need to quote that you passed out of where and which university, which institute, I think that's a red flag.
Yeah, for sure. I mean, I feel so as well. I totally believe that, like, it's uh, you know eh, of course it's great to have that sort of to have that pedigree and to have that sort of education, but if you keep saying it, then not just you but your entire team looks at it that way as well, and then investing is a group decision. So even if you're convinced about it, it can put off members also of your team when an investment decision is being taken, when they are, if they show so much of that bravado, then these are long 10-year journeys, and at the end of the day, it's the team also. It's not just me that'll engage with those founders. It's the team as well that engages with them, and they have to have that belief that this founder will do it, and it's not just a one-on-one with an individual. At the end of the day, we're building an institution, right? So it's not just some founder and the managing partner engaging, right? It's a group that's engaging with the entrepreneur and his or her company. So I think that buy-in has to be there, from top to the middle level at least, where when we are having a decision on investing, and especially when you talk about early stage, I think that's even like more critical to have the buy-in from the team, and like not just me, right?
Sure. In one of your podcasts, you've spoken about metaverse and gaming,
Yeah.
right? And if Sharp Ventures had to have a virtual avatar today,
Yeah.
what do you think it'll be? A serious investor, a wise sage, or a party animal?
I mean, that's a really cool question. I think, I'm sure there'll be multiple avatars that one can like, think about,
Just
and
one.
create. But I would say it would be a wise sage. Um, Investing is a long journey, and you will, at the end of the day, you want to have an enjoyable journey, and of course, you want great outcomes. Um, but I think that the continuous learning will only add value to the founders and the business, and all businesses, at least from the time I invest till the time I exit, they're not all going to be like multi-baggers, right? I mean, fine, I'd love to think that, but I'm fooling myself, I'm fooling others. It doesn't happen. um, but I think just having the wisdom to learn from the founders, from their mistakes, from the businesses, and from our own mistakes, I think, and then creating a virtuous cycle out of that by continuously sharing those learnings with other founders, and when they're on their journeys, I think those lessons are golden. And I think that if I'm a observer on the sidelines, which we are as investors, of course, we want to add value, and we want to be participative in as investors in their journey, and maybe value add in terms of strategy or in terms of networks, doors, whatever, talent. But we will also learn along with them, and some of those learnings can get cross pollinated to other companies in the portfolio, or why repeat some of those mistakes again, right? When you've seen this movie earlier, you've seen how this is being played out, then you can take some of that learning and say, look, I think what you're doing is wrong, or I think that's fantastic what you're doing, and I've seen pattern recognition taking place, and because of that, we believe this is what we believe.
Great. Rishabh, one book or role model that has helped you shape your thinking, especially when it comes to family office investments or leadership?
So I think a couple of one or two, I think, people that come to my mind. One is, of course, my father.
Of course.
It's just close. It's just at home, and it's because I think I've seen, like Marico from the sidelines, and his level of discipline when it comes to your strategy and what to do and what not to do.
But
And
actually, I should have asked you, apart from Mr. Harsh Mariwala.
yeah, sure. So we have a
That's a given.
Of course, of course. But I'll just share with you that with him, because if he hadn't pushed me on just being disciplined in terms of what I will do, what I'll not do, I could have made a lot more money. But I could have lost a lot of money as well. But just just because I have money doesn't mean that I'll spend it on venture capital. He wanted me to make mistakes. He wanted me to learn. He wanted me to go slow on my investments. If I'd gone fast on some of those investments, I would have made a lot more. but it's fine. In hindsight, it all sort of adds up and makes sense, because those learnings also are hard learnings with capital. And if that discipline and structure had not been there, thanks to some of his guidance, that wouldn't have happened the way in which we built it up. And the other gentleman is one of our board members, Mr. Nikhil Khatao, who again he runs a P fund called Mayfield. And what he said is, like, you should just dip your toes, don't get your feet wet, and when the tide turns in, who's swimming naked.
Okay.
And basically his point was that just don't go all in. You learn lessons. And it's similar to what my father said, but even with investments, we made lower ticket investments. We didn't go big bang.
Yes.
We learned our lessons in terms of we were sort of sector agnostic for the first 5 years, and with small investments, and that sort of helped us, because in 2020 we became sector specific with just consumer. And if it was not for that pattern recognition of saying that, okay, fine, we did tech deals, we did like medical research, clinical trial companies, we did like soft security hardware companies, and then we look back and we're like, okay, we have no business doing this because we don't understand the space, and we have no business diligencing it because we don't get it. So if it wasn't for people like Nikhil, I think our strategy wouldn't be as clear as it is today.
Yes, absolutely. So, Rishabh, thank you so much. This has been greatly, deeply insightful. We found a lot of value, and I hope our listeners find a lot of value in this podcast as well. Really like to thank you once again for your precious time.
No, thank you so much, and pleasure talking to you and the DSP team, and I sort of look forward to working with you.
Thank you, Rishabh.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.